Welcome back to the Deep Dive. Today we're tackling what has to be the most confounding story on the market this quarter. Broadcom Inc., ticker AVGO.
Yeah, this one is a real head-scratcher.
We're going to jump right into their Q4 and fiscal year 2025 results call, which was on December 11th.
And it was a classic sell the news event, but with a really strange twist. The company posts this overwhelming victory, a huge beat, a raise in guidance, and the market just punishes them for it.
And that's our mission today. Broadcom stock took one of its worst single-day hits in a long time. It dropped 11.43% the next day.
On 4 times the average volume, too. It was a stampede for the exits.
So how do these phenomenal results lead to a market reaction that severe? Our job is to dig into the details and sort of, reconcile that strange tension for you.
I think this deep dive is so important because it really shows you the mood of the market right now. It's not just about growth anymore.
Right.
The market is looking with a microscope at the quality of that growth, the profitability of this whole AI boom. Any hint of margin pressure gets a really swift reaction.
Okay, so let's start with the hard numbers, the stuff that on paper looked fantastic. Broadcom delivered a clear beat and raise for Q4.
Yeah.
Their non-GAAP diluted EPS, so that's earnings adjusted to show core performance, came in at $1.95.
Which handily beat the consensus of $1.87. That's about a 4.3% beat. Pretty solid.
And revenue was just as strong. They posted $18.015 billion.
I mean, that's more than $500 million over what the street was expecting. A huge 28% jump year over year.
And what's crucial is they're not just, chasing empty revenue. The profitability is still top tier. Their adjusted EBITDA was $12.218 billion.
Which is 68% of their revenue, an extraordinary margin.
Exactly. And then their forward look, their guidance was just as bullish. For Q1 of 26, they're guiding revenue to around $19.1 billion.
Again, targeting that same 28% year-over-year growth. And they see EBITDA margins holding steady around 67%. So, you look at those headlines, and the company is just firing on all cylinders.
Okay, so if the performance was stellar and the guidance was strong, where's the disconnect?
Yeah.
We have to go straight to the source of that strength, which is, ironically, also the source of the pain.
It's all about AI. The engine driving everything is this explosion in demand for their AI semiconductor.
We're talking about their custom chips, their XPUs, and especially their high-speed Ethernet switches that connect all these massive AI data centers.
The AI numbers in Q4 are they're staggering. AI semiconductor revenue hit $6.5 billion for the quarter.
That is up 74% from last year, 74%.
And management even said this one revenue stream has grown more than 10 times in just 11 quarters. This isn't growth, it's hyper-growth.
What really should give investors confidence, though, is the visibility they have. This isn't just a good quarter. They have a locked-in future. They have a total AI order backlog of over $73 billion.
$73 billion.
And they gave a timeline. They said they expect to ship that entire $73 billion backlog and turn it into revenue over the next 18 months.
That kind of visibility is, it's almost unheard of in the chip industry. They usually work on much shorter timelines.
And these aren't just flimsy commitments. They got another $11 billion order from Anthropic.
Right, the big AI model developer. And that's on top of a $10 billion order they already had. This is a massive, multi-year strategic deal.
They also locked in a 5th major custom chip customer, a new one, with an initial order of $1 billion for late 2026. This proves their strategy is working across multiple big players.
And don't forget the networking side. The backlog for their AI switches, especially that new Tomahawk 6, is now over $10 billion.
So the momentum is just accelerating. For Q1, they expect AI revenue to nearly double year over year to $8.2 billion. So here it is, the pivot. If demand is locked in, the backlog is $73 billion. Growth is doubling.
Yeah.
Why did the market panic?
This is the aha moment. The entire stock sell-off hinged on one comment from management on the call. They said that the higher mix of AI revenue is expected to dilute the company's consolidated gross margin by about 100 basis points.
Okay, let's pause there. 100 basis points. For anyone listening, that just means a drop of 1 percentage point. Why on earth would a 1-point shift cause a nearly 12% crash in the stock?
Because the market read it as a fundamental change in the business model. The dilution comes from 2 things. First, component pass-through costs, especially for HBM high bandwidth memory.
Which is essential for these AI chips.
Exactly. They're basically buying this really expensive specialized memory and then passing the cost straight through to the customer.
And the second factor, which I think is what really spooked people, was the rise of what they called system sales. What does that actually mean when Broadcom says they're selling systems?
That's the key. Traditionally, Broadcom sells chips. High margin, beautiful silicon. Now, for these huge customers like Anthropic, they're acting more like a systems integrator. They're selling the whole server rack.
So not just the chips.
Not just the chips. They're buying the cooling systems, the power supplies, the physical rack, other networking gear, putting it all together and selling the entire integrated system.
So their total revenue goes way up because of all these third-party parts, but the profit percentage on that bigger number goes down.
Precisely. The dollar profit from their actual Broadcom chips is still fantastic, but you divide that by a much bigger total revenue number, and the percentage, it has to drop. The market is obsessed with that percentage.
And they see it as a sign of what? Competitive pressure, or that their core business is less valuable?
Something like that. Management tried to counter this, of course. They argued that while gross margin percentage drops, they'll make it up with operating leverage. They'll keep R&D and other operating costs in check, so the operating margin dollars will still grow like crazy.
But the market wasn't buying it.
Clearly not. For the stock to fall that hard, investors are betting that the margin hit is real and won't be fully offset. They're worried Broadcom is becoming less of a pure play, high-margin chip designer, and more of a lower-margin systems company.
Got it. On a related note, they also talked about the supply chain, which is always a concern when you're growing this fast.
Yes, and they're being proactive. They announced they're building their own advanced packaging facility in Singapore.
Which is a huge bottleneck for the whole industry right now.
A massive bottleneck. So by bringing some of that in-house, they get more control and can make sure they deliver on that $73 billion backlog. They also said they're still at the front of the line for 3 nanometers and 2 nanometer chips from TSMC.
Okay, let's shift away from AI for a second and look at the foundation of the company, the parts that often get ignored.
Right, the boring but profitable parts. So semiconductor solutions without AI, that's about $4.1 billion in Q1, and it's basically flat year over year.
So not a growth driver.
Not at all. Broadband is recovering, but general enterprise spending is still pretty weak. So it's stable, but that's about it.
Then you have the real profit engine, infrastructure software. This is the stabilizer.
An absolute monster. $6.9 billion in Q4 revenue, up 19%, mostly from the VMware acquisition.
And then the margins here are just incredible.
This really highlights the dynamic we were talking about. Infrastructure software hit a 93% gross margin in Q4.
93%.
Yeah.
So you can see why the market gets nervous when you start blending that with lower margin system sales.
Exactly. And we have to be clear here. There are 2 different backlogs. The software side has its own $73 billion backlog.
Wait, another $73 billion?
Another $73 billion, one for AI chips, one for high margin software renewals. That combined visibility is just unprecedented. The business is built on a rock solid foundation, no matter what happens quarter to quarter.
Okay, let's pull all this together. Zooming out, the disconnect is just so clear. The stock was up 3% before the call.
Then the Q&A started, they explained the system sales, and the bottom just fell out. It closed the next day down 11.43%.
Nearly $50 a share, gone.
And you have to remember, the stock was up about 75% for the year heading into this.
Yep.
The bar was set for absolute perfection, and that one little asterisk on margin was enough for people to take profits and run.
So the catalyst summary is simple. The market saw margin risk and completely ignored the massive 18-month revenue guarantee from the backlog.
Looking ahead, the story is all about execution. They need to prove over the next couple of quarters that the AI growth really does translate to operating leverage. And they need to show they're converting that backlog smoothly into revenue.
All right, that brings us to our favorite segment where we take all this and build an idea. And of course, the mandatory disclaimer. This is not financial advice. Please do your own homework.
We are definitely seeing a dislocation here. You've got extreme locked-in long-term demand with that backlog versus an immediate market panic over a 1% margin issue.
The market is overreacting.
Massively. They're focused on a temporary mix issue and ignoring that AI revenue is literally doubling next quarter.
So the idea here is to lean into that. We'd pitch a long position on AVGO, betting that this margin fear is temporary. But to protect against the whole sector staying weak.
Right, because the SOXX index was also down 4 or 5% that day. You'd pair the long AVGO position with a short on a benchmark ETF like SOXX to hedge out that broader semiconductor risk.
So you're betting specifically that Broadcom will outperform its peers.
Exactly. The bet is that the demand story, the security of those massive backlogs, is way more important than the mix story over the next few quarters. This sets you up for what we call a raise and reweight. where the stock gets its high multiple back once the market sees the operating leverage is holding up.
The conviction really comes from the fact that management wasn't hiding this. They were transparent about it while also announcing these record-breaking deals. They know that dollar growth is what ultimately matters.
And we think the market will eventually come around to that view.
So to wrap this all up, the key takeaway is that Broadcom's AI growth story is completely secure. That $73 billion backlog is real and accelerating. The job for management now is just to prove quarter after quarter that this incredible growth can translate into stable operating leverage, even with this shift to system sales.
The pressure's on them to execute.
And to leave you with a final provocative thought. Management said that non-AI chip revenue is stable because AI is sucking the oxygen out of other parts of enterprise IT spending. So AI is cannibalizing the general IT budget.
An interesting dynamic.
How long can that hold? What happens if stability turns into actual contraction because all the capital is going to AI? It makes you question how durable that non-AI foundation really is if this trend continues.
A fascinating question to watch over the next year.
Thank you for joining us for the deep dive. We'll catch you next time.